In the financial world, it feels like we're just constantly swimming in information analysis.
Oh, absolutely. Every expert opinion, every prediction.
Yeah, and every alert promises something vital. But how do you actually, cut through all that noise, find what's genuinely useful?
Without getting totally overwhelmed.
Exactly.
Okay.
And that's what we're aiming for with this deep dive.
Right. Our mission today, we're going to try and cut through that noise and really dive into this idea of undervalued dividend stocks,
Yep.
for passive income.
Okay.
We want to unpack why some companies are being flagged as these hidden opportunities. Coiled springs, people call them.
Coiled springs. I like that.
Yeah.
Especially when the S&P 500 is, near all-time highs.
Precisely. It's about finding those maybe diamonds in the rough that might be poised for a rebound.
Okay. And we're pulling our insights today from a pretty interesting recent article from the Motley Fool.
That's the source, yeah.
Yeah.
It takes a really focused look at 3 specific companies they think fit this description.
Got it. So the goal here is to arm you, our listener, with some maybe surprising facts, actionable knowledge, help you make more informed decisions, and frankly, maybe sidestep some of those, emotional traps in investing.
That's a huge part of it. The article really hits on how investing mistakes are often driven by emotion, panic selling,
We're chasing that hot stock. FOMO.
Exactly. Fear of missing out. It derails people. But dividend stocks, because they provide that regular income, they can sort of build a psychological buffer.
A buffer? How so?
Well, you get a return without having to sell your shares. You literally get paid to wait it out. It counters the panic, the FOMO.
That makes perfect sense. It's like a built-in patience tool. Okay, so the first company they flag in this bargain bin, despite the market highs, is United Parcel Service, UPS.
Right. And UPS has really, really struggled this year. I mean, down 28%, while the S&P 500 is up, over 8%?
Wow, 28%. Yeah, that's a massive gap.
It really is. And that huge decline puts UPS shares, as the article says, squarely in that bargain bin, gives investors a chance to maybe pick it up at a discount.
And what about the dividend?
It comes with a pretty hefty forward-yielding dividend, 7.2%.
The 7.2%, okay.
Yeah, that's the expected annual payout relative to the current price. Now, the stock's poor run reflects, investor nervousness. Revenue and earnings are down year over year.
Why is that?
Mostly higher costs and some uncertainty around international trade policy, things like that.
Okay, so the market's basically seeing trouble and putting it on clearance, but the article pushes back on that.
It does. It points to what management is doing. They're actually projecting $3.5 billion in cost reductions by 2025.
$3.5 billion. How?
Through network changes and these initiatives they're calling Efficiency Reimagined.
Efficiency Reimagined. Sounds good on paper, but given the recent struggles, how likely is that? What are the hurdles?
That's the million-dollar question, isn't it? I mean, these are projections, but management seems careful about the dividend sustainability.
Okay.
Look at the last 5 years. UPS has kept an average payout ratio of about 76.9%.
So paying out over 3/4 of their earnings as dividends.
Exactly. Which suggests, pretty strong financial health underneath and a real commitment to shareholders.
Yeah.
So for investors who can stomach some near-term bumps.
And have that long-term view.
Right. The strategy to cut costs while keeping that strong dividend, it makes it look, pretty compelling.
Okay, so UPS is trying to fix things internally, but the next coiled spring, Freeport-McMoRan, that involves more of an external shock, right? Takes us into materials. Copper.
That's right, FCX. Their stock dipped recently, and there was a very specific trigger.
What happened?
It was a direct result of a policy announcement from the Trump administration regarding copper tariffs.
Tariffs again?
Yep. They basically exempted imports of refined copper from the big 50% tariffs, only applying them to semi-finished products.
And that was bad for Freeport-McMoRan because...
Because about a third of their copper is U.S.-based, and they produce over 70% of the refined copper here. So no protection from imports.
Ouch.
Yeah, and it also hit speculators who'd bid up the U.S. copper price way high, over a 25% premium, expecting those tariffs. That premium just vanished.
Okay, so a policy change directly whacked their valuation. But the article still argues there's value there, even after that.
It does. If you look at the bigger picture, management projects generating, $8.5 billion in operating cash flow in 2026, 2027, if copper's at $4 a pound.
Okay.
And $11 billion if copper hits $5 a pound.
And where is copper now after the announcement?
It tumbled to about $4.35 per pound in the U.S. So you plug that into their model.
You got
Around $9.55 billion in operating cash flow for 2026, 2027.
Okay, $9.55 billion. How does that compare to their market value?
Well, their current market cap is about $56 billion. So that implies a price to operating cash flow ratio of roughly 5.9 times.
5.9 times. Is it considered good?
Generally, yes. It's seen as cheap, both compared to history and just on an absolute basis. It suggests the market might be, overreacting a bit to the tariff news.
Interesting. And they still pay a dividend?
Yep, a 1.5% yield. So the argument is the underlying business is solid, despite the policy noise.
Right. Fundamentals are still there. Okay, so our final coiled spring. This takes us somewhere totally different, proving these chances aren't just in, like, shipping or mining.
Exactly. We're heading into semiconductors with Texas Instruments, or TI.
TI, what's the story here? They had a sell-off, too.
They did, yeah. After their Q2 2025 earnings report. Now, the headlines looked okay. Revenue and earnings per share were up, like 16%.
Okay, so what spooked the market?
Weakness in key end markets, particularly automotive, which is big for them. And again, those tariff risks are casting a bit of a cloud on near-term growth forecasts.
So similar themes then. Headwinds like UPS with costs or Freeport with policy. But TI, they're a giant in semiconductors. How do they fit the passive income angle? Especially for tech investors usually chasing growth.
Well, TI makes analog chips and embedded processing products. This is really essential stuff across the whole economy.
Like what, specifically?
Think factory automation, medical equipment, smart grids, all the sensors in cars, even personal electronics. It's fundamental.
Okay.
And what's really interesting, kind of unique about TI is their business model. They do most of their own manufacturing.
Oh, right. Unlike, say, NVIDIA, who are fabless.
Exactly. NVIDIA designs, someone else builds. TI's vertical integration, well, makes them more capital intensive. Sure.
More investment up front.
Right. But it also gives them way more control over their supply chain and their manufacturing costs.
Yeah.
Especially useful during industry downturns.
That makes sense. A real differentiator, that control. So maybe not the explosive growth of AI chips, but steady foundational growth potential.
That's the idea. And then there's the dividend. For a tech company, it's pretty solid.
How solid?
It's yielding 2.9%, which, compare that to Qualcomm at 2.1%, or others like Applied Materials, Lam Research, Broadcom. They're often under 1%.
Okay, 2.9% is quite good for tech. But what about valuation? Is it expensive now?
That's a fair point. Its current price-to-earnings ratio, the PE, is around 35.8, which, yes, looks high, especially during a slowdown.
Right.
But consensus analyst estimates, they're calling for $6.65 in earnings per share in 2026. If that happens, based on current prices, the PE drops to a much more reasonable 28.4.
Ah, okay, so the current high PE might be temporary.
Could be. Because TI is cyclical, its performance goes up and down with the economy, you really have to look at its long-term earnings potential, its foundational role, rather than just short-term PE swings. The current valuation might just reflect the down part of the cycle.
Okay, that makes sense. So wrapping this up, what does this all mean for you, the listener? We've looked at 3 companies, UPS, Freeport-McMoRan, Texas Instruments, all flagged as these undervalued dividend stocks, these coiled springs.
That's the core idea, really. Dividend stocks can be this powerful tool, not just for passive income, but also maybe helping you invest more rationally, less emotionally, especially if you find quality companies that are trading at a discount for temporary reasons.
Right. So UPS tackling costs, Freeport weathering that tariff shock, TI with its essential tech and unique model looking past a cyclical dip.
Exactly. UPS is about that internal turnaround potential plus the dividend. Freeport offers underlying value despite external news. And TI gives you that foundational tech exposure with a solid dividend if you look long term.
And bring it back to you, the listener, thinking about market cycles and long-term value, maybe seeking out these kinds of companies, these coiled springs with strong fundamentals facing temporary issues, could be a compelling strategy.
It's about looking past the day-to-day noise, finding that quiet strength.
Definitely food for thought.
And maybe it leaves you with a final question to chew on. Thinking beyond these specific stocks, what other foundational industries or maybe overlooked sectors out there might be quietly getting ready for a rebound? And how could understanding their cycles, their essential role, how could that reshape your own long-term investment view?